Hello, listeners. Welcome to the Morning Market Update, the podcast powered by AI. I'm Joe.
And I'm Sarah. Today is February 12th, 2026. Let's dive in. We are seeing a bit of a green start to the morning here in the U.S. markets. Stock futures are edging higher as traders digest a mix of earnings reports and some fresh economic data. The Dow Jones Industrial Average is looking particularly resilient this morning, buoyed by a surprise in jobless claims that has investors recalibrating their expectations for the Federal. On the broader front, the S&P 500 and the Nasdaq are also pointing toward a positive open. We just got the January payrolls report, which showed the U.S. added 130,000 jobs. That was actually more than expected. It's a bit of a good news is good news situation today because it provides some relief to those nagging concerns about a hard landing, and it's pushed the unemployment rate down to 4.3%. Interestingly, we're seeing an Olympic-size rally in industrial and cyclical stocks. These are the companies that move in lockstep with the economy, and right now, investors seem to be betting on continued growth despite high interest rates. However, it's not all sunshine. The Russell 2000 is seeing some localized volatility, and we've got some major individual laggards in the tech space that we'll get into shortly.
Switching gears to the Great White North, the TSX in Canada is under the microscope today. It's been a bit of a roller coaster for Canadian equities, largely driven by the ongoing drama surrounding trade relations with the U.S. The big news that's giving Canadian investors some breathing room is the U.S. House of Representatives voting to override President Trump's Canada tariffs. This is a massive development for the TSX, as it relieves some of the immediate pressure on our manufacturing and energy sectors. However, the market isn't entirely in the clear. One of our tech darlings, Shopify, is seeing its stock drop significantly this morning. Even though they actually beat revenue expectations and announced a massive $2 billion buyback, they missed on earnings and gave a cautious forecast for free cash flow margins. It's a classic case of the market demanding perfection. On the flip side, Restaurant Brands International, the parent company of Tim Hortons, is a bright spot. Their earnings topped estimates, largely thanks to strong international growth for Burger King. So, while the macro tariff environment is looking more favorable for Canada today, individual earnings are really dictating the winners and losers on the TSX.
Looking across the oceans, it's a fairly busy session for international markets. In Asia, we saw emerging market stocks rally for a fourth straight day. South Korean tech stocks led that charge, but the real story was in China. The Jipu-led rally in Chinese AI stocks saw some companies surging as much as 30% following a wave of new product releases. The Nikkei in Japan held steady, while the Nifty 50 in India continues to show resilience. Over in Europe, the mood is a bit more somber. The FTSE, DAX, and CAC 40 are dealing with some heavy earnings misses, particularly in the auto sector. In the commodities space, we're seeing a significant move in soybeans, which hit a 3-month high. This is coming off optimism about a potential trade truce between the U.S. and China, which could lead to more agricultural purchases. Meanwhile, oil prices are being prodded upward by a vast hoard of sanctioned oil stranded at sea, which is tightening the market. And in the crypto world, Bitcoin is being incredibly stubborn. Standard Chartered actually slashed its 2026 target for Bitcoin by 33%, warning of a potential slide toward $50,000, even as some bulls try to ignore the extreme fear sentiment currently gripping the digital asset space.
Now, let's zoom in on some major North American corporate stories that are moving the needle for the S&P 500 today. First up is Cisco. The stock is taking a 7% hit this morning. It's a tough break because their revenue and earnings actually topped estimates, but the forecast for the coming months was just mediocre. In this high interest rate environment, mediocre is a sell signal for many. Then we have Lyft, which is sliding a massive 15%. Their rider metrics fell short of what Wall Street wanted to see, and their guidance was soft, even though CEO David Risher insists there's no softness in consumer behavior. Another major story to watch is Icon plc. Their shares have plunged in pre-market trading after launching an accounting probe. They admitted they may have overstated past revenue and have pulled their guidance for the year. That is never something you want to hear as a shareholder. Finally, keep an eye on McDonald's. They are pushing a value strategy that seems to be resonating, and their stock is leading some of the Dow movers this morning as investors look for safety in consumer staples.
Moving to the international corporate scene, the headlines are dominated by Mercedes-Benz. The German luxury carmaker reported that its full-year profit has more than halved, and it's blaming a staggering $1.2 billion in tariff costs. It's a stark reminder of how geopolitical trade wars are hitting the bottom lines of European giants. In energy, Total Energies has made some waves by calling the U.S. administration's Venezuela dream too expensive and too polluting. Total Energies exited the country years ago, and they aren't looking back. We also saw a bit of a bumpy comeback for Brazilian IPOs in the U.S. market. A pair of fintech rivals tried to list, but they ran headfirst into wavering investor appetite and market turbulence. It shows that even with a global tech rally, investors are still very picky about which emerging market companies they're willing to fund. Lastly, keep an eye on the European Commission. Top prosecutors are reportedly investigating the EU's executive body over possible misconduct related to real estate sales in Belgium. It's a developing story that could add some political instability to the Eurozone.
On the economics and geopolitics front, the big theme is the tariff war. We saw U.S. tariff revenues soar by more than 300% in January, which actually helped shrink the U.S. budget deficit. But as we saw with Mercedes, those gains for the government are often costs for the corporations. The U.S. House's attempt to override the Canada tariffs is a sign of internal political friction in Washington that markets are watching closely. Meanwhile, the Fed is in a tricky spot, with the labor market adding 130,000 jobs and unemployment falling. The higher-for-longer narrative for interest rates might have more legs than some traders hoped. Geopolitically, Russia seems to be shrugging off tariff threats regarding Cuba, and the trade truce talks between the U.S. and China are providing a rare bit of optimism for the agricultural sector. It's a complex web of trade policy and central bank maneuvering right now.
To wrap things up, here are your key takeaways for the day. First, the U.S. labor market is still showing incredible resilience, which is a double-edged sword for interest rate cuts. Second, the earnings bar is set very high right now. As we saw with Cisco and Shopify, beating estimates isn't enough if your forward guidance is weak. Third, tariffs are no longer just a headline. They are actively impacting the bottom lines of global giants like Mercedes-Benz. Fourth, keep an eye on the technical levels for Bitcoin. With Standard Chartered lowering targets and sentiment remaining bearish, we could see more volatility there. And finally, the TSX might see a relief rally on the back of the House tariff override, but individual stock performance remains hit or miss.
That wraps up today's update. I hope you gained useful insights into the markets this morning.
Add your thoughts in the comments and follow for more such updates. This is Sarah.
And Joe, signing off.